Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Swire Properties Limited Annual Report. Swire Properties Limited offers a diverse range of businesses and services across various segments. In the property investment segment, the company develops, owns, and manages commercial properties, including mixed-use developments. This involves leasing and managing these properties to generate revenue. In addition to property investment, Swire Properties also engages in property trading, where it buys and sells properties to maximize returns on investments. The company's hotel segment is another key area of focus, with the development and operation of hotels that cater to both business and leisure travelers. The company also provides financial services, including real estate agency services, which enable customers to buy or sell properties through its network of agents. Furthermore, Swire Properties develops and sells residential apartments, offering a range of housing options for individuals and families. Overall, Swire Properties Limited's diverse portfolio of businesses and services makes it a significant player in the property development and management industry. Swire Properties Limited market capitalization of $140 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Swire Properties Limited holds a significant advantage in their industry. Swire Properties Limited trades at a lower price-to-book ratio of 0.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.74%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. In terms of property trading, the segment experienced significant growth from $68 million to $110 million between 2024 and 2025. This increase was driven by various factors such as lease commencements, rent reviews, and break option dates. Additionally, residential property sales growth was fueled by the transfer of legal title to buyers. The hotels segment also saw an increase in revenue from $188 million to $917 million during the same period. Furthermore, rental income growth was driven by lease commencements, rent reviews, and break option dates. Sales of goods and services also contributed to revenue growth, with delivery of goods to customers and rendering of services being key drivers. On the other hand, revenue decline can be attributed to several factors. Gross rental income from investment properties decreased by $437 million, 3.2%, between 2024 and 2025, resulting in a decrease in revenue. Loss on disposal of investment properties also had an impact on revenue. Furthermore, capital expenditure in response to climate change may have had an effect on the company's financial performance. In conclusion, revenue growth is primarily driven by property trading, hotels, rental income, residential property sales, and sales of goods and services. Revenue decline, on the other hand, can be attributed to gross rental income from investment properties, loss on disposal of investment properties, and capital expenditure in response to climate change. The company's financial performance is a notable aspect of its overall health. According to the provided information, the company is generating positive operating cash flow. This is evident from two key indicators: cash generated from operations and operating profit before working capital changes. On page 16, It is stated that the company has generated 10,024 HK$M in cash from operations for the year 2025. This figure demonstrates a significant inflow of funds into the business, indicating a positive operating cash flow. Furthermore, on page 206, it is mentioned that the company's operating profit before working capital changes amounts to 86.95 for the same period. These two indicators collectively confirm that the company is indeed generating positive operating cash flow in 2025. This is a crucial aspect of a company's financial performance, as it indicates its ability to generate sufficient funds from its core operations to meet its financial obligations and invest in growth opportunities. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there is a mixed picture. On one hand, net debt decreased by 10% from HK$43,746 million to HK$39,540 million in 2025, indicating a reduction in debt. However, total debt increased by 4.8% and 6.5% in different periods, suggesting an overall increase in debt. Regarding interest expenses, the trend is more consistent. Interest expenses have generally decreased over the past year, with notable reductions of 39.4%, 1.7%, and 10.3%. The only exceptions are a slight increase of HK$22 from HK$123 to HK$145, and an increase in interest expense from HK$50 million to HK$53 million. Overall, while there is some variation in the company's debt level, interest expenses have consistently decreased over the past year, indicating a reduction in financial burden. The company's performance across various segments has been mixed. On the positive side, property investment has been a standout performer, with significant profits recorded in both 2024 and 2025. The segment generated HK$13,014 million in profit in 2025 and HK$13,452 million in 2024. Property trading also showed promising results, with revenue of HK$110 million and a profit of HK$186 million in 2025. These strong performances suggest that the company's focus on property-related activities is paying off. However, not all segments have fared as well. The hotel segment has struggled, generating only HK$917 million in revenue and a meager HK$16 million in profit in 2025. Furthermore, the change in fair value of investment properties resulted in a significant loss of HK$1,041 million in 2025. Overall, while some segments have performed well, others require attention to improve profitability. Management's vision is to be the leading sustainable development performer globally by 2030. They are confident in Hong Kong's long-term outlook and committed to shaping its urban landscape while supporting communities. The company aims to deliver sustainable growth in dividends with a mid-single-digit annual growth rate. To achieve this, management is executing an HK$100 billion investment plan, focusing on capital recycling, expanding presence in the Greater Bay Area, and building momentum across the retail portfolio. They prioritize sustainable development, maximize earnings and value of completed properties, and manage the capital base conservatively. Management remains committed to investing in development projects in Hong Kong, Chinese mainland, and residential trading projects, including in Southeast Asia, over the next 10 years. They also aim to maintain a stable capital structure to ensure the company's ability to operate as a going concern. In addition, management is focused on achieving measurable objectives on board diversity, investing in geographic portfolio despite macroeconomic developments, and committing to gender pay equity and CEO pay ratio. They plan to pace new projects with market demands, expand presence in other markets, monitor disruptive business models, and manage climate risks through regular assessments and transition to net zero carbon emission targets. Overall, management's strategy is centered around sustainable development, growth, and long-term value creation for shareholders while maintaining a stable capital structure and prioritizing corporate governance. The company has made several strategic acquisitions and divestitures over the years. In terms of acquisitions, the company has purchased a plot of land in South Jakarta, acquired a 40% interest in a site on Wireless Road in Bangkok, and invested in Empire City, a residential-led mixed-use development in Ho Chi Minh City. Additionally, the company has identified opportunities for trading and investment with reasonable returns in Hong Kong markets, as well as residential development opportunities in the Chinese mainland. The company has also made several divestitures, including the sale of Brickell City Center shopping mall in Miami, shops at Brickell City Center in the USA, adjacent land parcels to the shops, certain residential units locally, and a Miami retail investment portfolio. Furthermore, the company has sold the North Squared site in Brickell, Miami, with an approximate GFA of 523,000 square feet, and disposed of a shopping center in the USA. These divestitures demonstrate the company's efforts to optimize its portfolio and focus on strategic investments. The company has a history of rewarding its shareholders through dividend payments and share buybacks. The records show that the company has paid dividends consistently from 2016 to 2025, with multiple interim and final dividend payments made throughout the years. In fact, the company declared and paid out significant dividends in October 2025. In addition to paying dividends, the company has also been actively buying back its own shares. The records confirm that the company has repurchased a substantial amount of shares in 2025, with a total value of HK$709 million. This demonstrates the company's commitment to returning value to its shareholders and reducing the number of outstanding shares. Overall, the company's dividend payments and share buybacks demonstrate its focus on rewarding its shareholders and creating long-term value for them. There are concerns about inventory buildup or supply chain disruption. The volatility of the economy has led to potential delays in property sales and leasing due to supply chain issues. These disruptions can arise from various incidents such as geopolitical events, resource outages, and natural catastrophes. As a result, businesses may experience stockpiling of goods, leading to inventory buildup and further exacerbating supply chain problems. That concludes the financial summary for Swire Properties Limited. Feel free to comment below, and I will be happy to answer them when possible.